As this graph shows, stock repurchases have become more and more popular over the years. So from 2000 and on, companies are more likely to repurchase stock back from their clients than they are to pay dividends. And this has been increasing. If you look at any company's financial statements, you will see that the amount of treasury stock that they own is quite large, and they'll talk about in their annual reports any future plans to repurchase stock back from the market. What are the tax effects of dividends and stock repurchases? Cash dividends are taxed as ordinary income to the owner of the share. As a shareholder, there's no control over the timing or size. The company decides when they're going to happen and how much they're going to be. A repurchase of stock allows investors to decide if they want current cash flow. So if you saw that a company was trying to buy back shares of stock and you decide to sell them, then that's your own decision that you decide to sell them back. If you receive a capital gain on the sale back to the company, you would be taxed on that capital gain. However, if you own the shares more than a year, long-term capital gains are taxed at a lower rate than short-term capital gains. This is one of the incentives of trying to prevent like short sales or short-term trading is that capital gains from short sales are taxed at a much higher rate than capital gains for stock that is owned over a year. We see the tax effects on dividends. So there was a tax cut enacted. So regular dividends from 2001 to 2006. The number of firms that initiated dividends per quarter. So you can see once there was a tax cut for dividends that the number of firms issuing dividends greatly increased. So cash dividends and stock repurchases are very large and have increased steadily. Dividends payments are heavily concentrated among a small number of large firms. So it might seem that a lot of firms pay out dividends, but it's actually a small percentage of firms that pay out all of the dividends versus the firms in the market. Managers are very reluctant to cut dividends. Remember, managers should be focused on stockholder value, and dividends are part of stockholder value. Managers will smooth dividends, though, raising them slowly as earnings grow. The expectation is that the longer a company is in business, the higher their earnings will be, partly because they'll grow, and then partly because as they get their assets, buildings, and stuff paid off and they decrease their debt, their expenses would decrease, which would also increase their earnings. So the availability of earnings to shareholders rises over the years. Stock prices react to unanticipated changes in dividends. So if a company has a regular dividend and changes that, the stock price is going to react to reflect that. Changes in the dividend signal management's view concerning the firm's future prospects. And this is really even increasing the dividend or decreasing the dividend. Any change that we make in the dividend can indicate that management either think there are future prospects or don't believe there are future prospects. Stock repurchases, this is a signal that management believes the current stock price is low. Remember that part of the stock price in the market is a component of supply and demand. And so if the price is too low, we can raise it by reducing the supply. Tender offers send a more positive signal than open market repurchases because there's a better return on offer for that. So they're paying a higher amount per stock through a tender offer than they would if they just repurchased in the open market. And stock prices often increase in reaction to the announcement of repurchases. What are the pros and cons of paying dividends? Pros: cash dividends usually mean that the company has good cash flows. It also increases the stock price. Dividends attract investors, especially investors who are looking for regular income. The stock price increases every time there's a new dividend or an increased dividend, and increases in the market usually indicate that a company is healthy. And dividends help us absorb excess cash. So if we don't have plans for our current cash, dividends are a way to help us manage that. And we're going to talk about cash management next week in a future chapter. And dividends reduce agency costs. So what are some of those agency issues that we have between managers and shareholders? We know that if managers are increasing shareholder value, generally shareholders are happy. What are the cons? Taxes. Dividends reduce internal sources of funding. So we pay dividends out of retained earnings, which lowers our amount of retained earnings available and lowers the amount of funding that we have available to take on new projects and to grow the organization. Once we establish paying dividends, it is really difficult to take that back without having a negative impact on the firm's stock price and even just investor trust in the company or what investors think about the company. So a company that was paying dividends that suddenly decides to stop paying dividends, investors might not only believe that that stock is no longer valuable, but that the company is in trouble financially or has plans to dissolve in the future or various other things. Whether they're true or not, it's just a perception about why would someone who was already paying dividends stop paying dividends. Factors that affect dividend decisions. So they did a survey of corporate managers about their dividend policy. And this is the result of that survey showing that managers are very disinclined to cut dividends. So you can see that 93.8% of managers said they try to avoid reducing dividends per share. They try to maintain a smooth dividend from year to year. Consider the level of dividends per share they've paid in recent quarters. So everything the chapter talks about is backed up in the results from these manager surveys. You can see that all of these statements in trying to avoid reducing the dividends, trying to maintain smooth dividend growth, are all supported by this survey. Companies do not have to give cash to shareholders. So instead of cash, we can distribute stock dividends. and this increases the number of outstanding shares of stock. A small stock dividend is less than 20 to 25% of the current outstanding shares, and a large stock dividend is more than 20 to 25% of outstanding shares. They both have completely different accounting treatments, which is beyond the scope of this textbook. Is just knowing the difference between a small stock dividend and a large stock dividend. We're not going to talk about the accounting treatment for a small stock dividend and a large stock dividend. Stock splits are similar to a stock dividend, except they're expressed as a ratio. So for example, a 2-for-1 stock split is the same as a 100% stock dividend. That's where we take every stock and change it to 2 stocks. Our stock price is reduced when we do a stock split. It often also reduces the par of the stock. So we essentially double the amount of stock that we have outstanding. And if we had dollar par stock, we would go from dollar par to 50-cent par on a 2-for-1 stock split. Usually this is done as a way to lower the price. So the company is actually trying to purposely lower the price. Maybe the price has gotten so high that stock sales have stagnated. People aren't inclined to buy very expensive stock, so they want to get it lower so there's a more desirable trading range so more people will buy it. Companies can also do reverse stock splits. And a reverse stock split, as you imagine, is just the opposite of a stock split. So instead of increasing the number of shares outstanding, we reduce the number of shares outstanding. So in a 1-for-5 stock split, we replace every 5 shares of stock with 1 share. Okay? Why would we do this? It might improve our liquidity. We might believe our stock price is too low, either to be considered respectable, or our stock price has gone so low that we risk not being able to trade on the current exchange that we're listed on. So NASDAQ has a minimum price. So if stock drops below $1 per share for 30 days, then NASDAQ will remove it from their list. And so a company would be incentivized to reduce the supply of their stock out in the market in order to help raise their price. So that's the minimum price per share requirements that stock exchanges have. So trying to do that. So that is the end of chapter 14.